Hello guys, today we're going to discuss about how to do accounting for a company, okay? A very important topic. I just love taking company accounts, okay? So before we go into accounting this, we will see how a company is formed. I'll quickly walk through the stages in the formation of a company to get a better idea, alright? So formation of a company. The first stage is called the promotion stage. What do you understand by promotion? I could say that it's a stage where a person or a group of person conceives the idea of starting a business. Okay, it's a stage where they discuss about starting a business, collecting all preliminary information. That is called the promotion stage. So the person who does this work, it could be one person or a group of person. They are called promoters. I'm sure you would have learnt it in your business studies, but just rephrasing that. So after collecting all the preliminary information, the next stage comes the incorporation. The term incorporation means registration. So all the informations are collected, necessary documents are ready. Is that enough to start a business? No, it is a company. Yes, so it has to be registered. And you guys know this company is governed by the earlier Act, Companies Act 1956. Now we are following the recent Act, Companies Act 2013. So the company has to be registered under this act. So with all the documents ready, they go meet the registrar of the company, kept the name registered in the books of register. So the registrar will enter the name of the company in his book and will issue a certificate called Certificate of Incorporation. So on that particular date onwards, the date on which the Certificate of Incorporation is issued, the company is legally into existence on that particular date. So thereon the company can enter into contracts, sign contracts on its name, do all business on its name. So it's legally into existence. Okay, now company is registered, everything is over, but you need to start doing the business. For doing a business, the main blood of the business is money. So you need to calculate, you need to subscribe for capital. So the next stage is capital subscription, collating the capital from various sources, okay. I think you have learnt in your business studies the various different sources of collecting capital. What are they? We have internal sources, external sources. You calculate money, you take off capital from within, or you also take money from outside. Okay, there are various sources from which you can take money. One is by issue of shares to public. The other thing is by issue of debentures to the public. We'll discuss about what a debenture is later. The next thing is by getting loan from bank and other financial institution. These are different sources from which you can arrange capital for your business. Okay. So, but in our particular chapter, this is accounting for share capital. So, we're going to deal about shares. Okay. Everybody has got something in their mind. What a share is all about. What is a share? People keep saying shares. What is a share? Shares are nothing but, see, you need a total company, you need a capital of a big amount, let's say 10 lakh or 1 lakh, okay? That's divided into a smaller portion, that's called share. So share can be defined as a unit of the total capital. The total capital of a company divided into small units called share, okay? So that is share. Share can have different denominations of value like 10 per share, rupees 100 per share. Generally in your problems you will come across 10 rupees and 100 rupees denominations. Okay, so this is called the face value of a share, nominal value. These are different names that we use. Shares issued at par. Par in a sense, it's face value or nominal value. So this is nothing but the share value. Could be either 10 or 100. Okay. Now let's say I need 1 lakh capital to do my business. I can divide this into 10,000 shares of rupees 10 each. I will get 1 lakh. Or I can even divide that into 1,000 shares of rupees 100 each. I'll still get that 1 lakh. So depending on the company, they will divide the capital into smaller unit. Okay. Now when it comes to different kinds of subscription, when you are issuing shares, you have learned in your business studies, the company prepares something called a prospectus. That's nothing but an invitation. They send it to the public, invite them to buy their company shares or to apply for shares. Okay. So whenever a company sends an invite, it will come across these 3 different types of scenarios or subscription. So company issues 10,000 shares to the public. Public also applies for a same number. That is, I get invitation, I get application for 10,000 shares. Invitation sent for 10,000 shares. application received for 10,000 shares, then this situation is called normal subscription because there is no change, okay. 10,000 shares are issued, public also applied for 10,000 shares, it's normal. The second situation is under subscription. I am sending invitation or I am issuing 10,000 shares to the public, but wherein the application that I received is only for 9,000 shares. It is less than what I have issued. That's why it's called under. It is less. The third case is oversubscription. This is totally a peculiar case that we have to discuss separately. Oversubscription is where I'm issuing 10,000 shares to public, but whereas public applied for more number, I received 12,000 shares or I received 15,000 shares, more than what I've issued. That's when you call it as a oversubscription, which has to be dealt in different manner. Okay, so these are the general stages in the formation of a company. Okay, this is what a share is all about in different types of subscription. We will see in detail how the shares are issued, okay, how this money is collected from the public, what different types of entries we need to pass in our accounting books, which you can see it in the following videos. Thank you so much.